Good morning, everybody. The July 24, 2018 School Land Board meeting will now come to order. First item on the agenda is number 1, approval of the minutes from our last meeting on June 19, 2018. After the board has had a chance to review the minutes and assuming no questions, comments, or objections, we can entertain a motion to confirm the minutes for the record.
I move to approve.
Motion is made, seconded, and carried unanimously to approve the minutes. Next item on the agenda is the approval of the consent agenda. I've been notified that there have been several items pulled from the consent agenda, so there are actual changes to that docket prior to the meeting. And those items are number 2A through 29, 2A 31, 2B 8, 2B 9, and 2B 10. So to repeat for the record, 2A 29, 2A 31, 2B8, 2B9, and 2B10 have been pulled from the docket prior to this meeting. After the board has had a chance to review and assuming no comments, questions at this time, I could entertain a motion to confirm the minutes or confirm the consent agenda with those changes.
I move to approve.
I'll second. Motion is made, second, and carries unanimously to approve the consent agenda. Items 3 through 5 will be considered an executive session, and will enter an executive session to pursue legal advice and deliberate about real property. We'll enter executive session pursuant to Chapter 551, Subchapter D, Section 551, Tech 071 of the Texas Government Code for consideration regarding pending or contemplated litigation or settlement offers, and to receive attorney advice or counsel-related items 3 through 5 on the docket, and subsection 551 Tech 072 for discussion consideration concerning purchase, sale, exchange, lease, or value of real property related to items 3 through 5 on the docket. Following executive session, we'll reconvene. The open session of the July 24, 2018 School Land Board meeting will resume with item number 3.
Good morning, Amber Long, Asset Management. Staff recommends approval of the disposition of excess land per the terms discussed in closed session as being in the best interest of the PSF. Any questions?
None. From me.
Is there a motion this time to confirm?
Are we doing 3 and 4 or just 3 right now?
Just 3.
All right. I move to approve item number 3 on the agenda.
Motion is made, seconded, and carries unanimously to approve item number 3. Next item on the agenda is number 4.
Amber Long, Asset Management. Staff recommends approval of the disposition of excess land per the terms discussed in closed session as being in the best interest of the Permanent School Fund. Any questions?
I move to approve item number 4 on the agenda.
Motion is made, seconded, and carries unanimously to approve item number 4. Next item on the agenda will be pulled from the docket as we do not currently have a quorum to vote on it. Mr. Burciaga had to attend a family emergency at the last moment, and I have filed a memo recusing myself from the vote on this matter, so we will table it at this time and revisit at a more convenient time for the board. Next item on the agenda is number 6, consideration and possible adoption of the School Land Board and Texas General Land Office Investment Vehicle Guidelines and other matters in connection therewith.
Thank you, Mr. Chairman. Members, for the record, Rusty Martin, Chief Investment Officer. Approval of this agenda item would constitute the adoption of the School Land Board and the Texas General Land Office Investment Vehicle Guidelines. In a report on the audit of the Permanent School Fund's fiscal year 2017 financial statements, which was published by the State Auditor's Office as SAO Report number 18-013, the SAO recommended that the General Land Office develop a policy that governs the creation, use, and dissolution of limited liability companies created by TexClo, and establish a monitoring mechanism to ensure that those investment entities are employed in accordance with the policy's guidelines. Subsequently, Investment Management and the General Counsel's Office worked with outside investment counsel to respond to the SAO's recommendation by developing the attached School Land Board and Texas General Land Office Investment Vehicle Guidelines, which I'll just refer to as the guidelines. Those guidelines were developed to facilitate the prudent management and investment of the money subject to the oversight of TexClo and the School Land Board by using different types of investment vehicles. The information contained within the guidelines establishes the global principles for tax close consideration and determination of the use, formation, maintenance, and termination of investment vehicles connected with its management of PSF investments. I'll go over the main sections of the guidelines and their primary content, starting with Section 3, which is entitled Use of Investment Vehicles. This section describes the uses of special purpose vehicles, or SPVs, such as isolation of liabilities, limiting future obligations, avoiding submitting to foreign jurisdictions, and enhancing the ability to sell or transfer an investment. Section 4 is entitled Types of Investment Vehicles, and this section defines the various types of SPVs, including limited liability companies, better known as LLCs, limited partnerships, also called LPs, and special purpose corporations, or SPCs. This section also describes the benefits of using each of those types of vehicles. It also states that the use and types of SPVs employed for investment opportunities as determined by the CIO may be in the best interest of the permanent school fund and be appropriate under the prudent investor standard. The CIO may consult with legal counsels and advisors to determine whether investments made by TexGlo should be made through SPVs, and if so, the appropriate form and structure for such SPVs. Section 5 is called the Formation of Investment Vehicles. This section describes the process for forming investment vehicles. Initially, the CIO, in his or her discretion, shall determine whether to recommend the formation and use of an SPV as part of the school land board's consideration and approval of specific investments. Upon the approval of the school land board and the CIO's recommendation as to whether to use an SPV and the form of the SPV to be used, the authority is delegated to the CIO to engage legal counsel, to form and organize the applicable SPV, to execute and file any associated documents, and to take any other necessary actions to establish its separate legal existence. Section 7 is the last one I'll go over. It's called Dissolution and Winding Up of Investment Vehicles. This section describes the factors that are considered when determining whether to dissolve an SPV and delegates the authority to the CIO to determine whether it's in the best interest of the permanent school fund to dissolve an SPV, and further delegates the authority to the CIO to engage legal counsel and other advisors to facilitate such dissolution. In summary, when TexGlo makes investments on behalf of the permanent school fund, it is often necessary to consider a variety of SPVs in determining the appropriate investment vehicle to employ in the execution of the investment. And the purpose of these guidelines is to provide TexGlo with guidelines for the use, formation, management, and termination of SPVs in the execution and management of permanent school fund investments. Therefore, staff is recommending that the board adopt the School Land Board and Texas General Land Office investment vehicle guidelines in the form as attached to the memo and as I've described earlier, and I'm happy to answer any questions.
So this was all put together with council?
Yes, my staff, general counsel here, and outside counsel worked together to create the guidelines over several months.
I move to approve.
My only question before we do that is, in the memo it says investment management and ties to the prior question, with outside investment counsel, is that legal counsel or it's tax advisors in terms of actually using?
It's outside legal counsel. It's a
Outside.
counsel that typically works with us when we're negotiating and finalizing documents related to the investments.
That's all I had. And assuming council's okay with that prior motion, I will second that motion.
Yes, I'm okay with that.
Motion is made, seconded, and carries unanimously to approve item number 6. Final item on the agenda is number 7.
Thank you, Mr. Chairman, members. I'm pleased to present you with a quarterly investment report of the TexGlo Permanent School Fund investment portfolio for the period January 1st to March 31st, 2018. As you're aware, the performance measurement calculations and the statistical data that are presented in the report were prepared by State Street Bank and its private edge group, which are the custodial accounting and performance measurement agents for the portfolio. Starting with an executive summary, which is on page 1 of the report, I'll briefly give you a market update before I go into details about the portfolio itself. First quarter GDP increased at an annual rate of 2% after having increased 2.9% in the fourth quarter of last year. That increase primarily reflected positive changes in non-residential fixed investment, federal government spending, personal consumption expenditures, state and local government spending, and exports, which were partly offset by decreases in residential fixed investment, private inventory investment, and an increase in imports. The unemployment rate ended the quarter unchanged at 4.1%. As far as the Fed is concerned, using their language, in view of realized and expected labor market conditions and inflation, the Federal Open Markets Committee raised its target Fed funds rate range from 1.25% to 1.50% to 1.5% to 1.75% at its March 2018 meeting. They also continued to tweak their balance sheet normalization process, which concerns a reinvestment of principal payments from its holdings in agency-backed mortgage securities and how it rolls over at auction maturing Treasury securities. So they have been working on that program for several months now and continue to tweak that as they remove a lot of the easing that was put on over the past few years after the recession. They continue to expect that economic conditions will evolve in a manner that warrants only gradual increases in the Fed funds rate. Therefore, the rate is probably going to remain below levels that are expected to prevail in the long run, and the actual path of the Fed funds rate will depend on economic outlook. It's indicated by incoming economic data, which they will be reviewing continuously. As far as the portfolio is concerned, the U.S. commercial real estate market, which is, as you know, is measured by the NCREIF Property Index, or NPI, returned 1.7% for the first quarter, and its trailing one-year return was 7.13%. The gross returns for each of the individual sectors were hotel, 1% flat, retail, 0.72%, apartment, 1.5%, industrial, a whopping 3.25%, and office, 1.8%. And industrial was once again the best performing sector by far at 3.25% during the first quarter. And that's because online shopping has created increased demand for what's known as last mile warehouse space in the market. And at the same time, this increased online shopping hurts many traditional brick and mortar retailers, which was reflected in their paltry 0.72% return for the quarter. In 2010, interesting enough, the retail sector was producing return spreads of about 125 basis points above industrial, but now that relationship has completely flipped because of online shopping primarily, and industrial spreads are now 200 basis points above those of the retail sector. In the energy markets, WTI spot oil prices averaged $62 to $64 a barrel. They ended the quarter at $64.87 a barrel, which was a 7% increase from the fourth quarter ending price of $60.46 a barrel, 46 cents a barrel. Those prices were primarily influenced by continued Middle Eastern geopolitical risk, expectations that up to 500,000 barrels a day of Iranian oil exports could be leaving the market, the likelihood that OPEC will extend its production cuts into 2019, an unexpected U.S. crude inventory draw at the end of the quarter, and increased political unrest in Venezuela. Also, ramping U.S. crude production continues to be the wild card in the oil supply and demand discussion. On the gas side, natural gas spot prices averaged $3.87 a million BTU in January, but averaged about $2.68 a million BTU during the rest of the quarter and ending the period at $2.81 per million BTU. That was a 3% below the fourth quarter average price of $2.91 a million BTU. Most analysts continue to think that rising industrial demand, LNG exports, increased exports to Mexico, and continued coal to gas switching will foster medium to long-term supply-demand support. However, there's an upcoming wave of infrastructure build-outs in the Appalachian Basin. They're scheduled to come online in 2018, and substantial amounts of associated gas related to the ramp-up in U.S. domestic oil drilling will also probably reinforce short-term pressure on prices. As far as the portfolio performance is concerned, if you'll look at the performance measurement tab, I'm looking at page 2 of the report. Total NAV at the end of the period was approximately $6.5 billion. About 3.2 of that is in the portfolio, and 3.3 is in cash awaiting investment. For the quarter, the portfolio performed 1.49%, which was about 62 basis points under the benchmark of 2.11%. Although the infrastructure portfolio, portion of the portfolio was up 2.37% for the quarter, and real estate was up 2.32%. Energy was up only about 0.44%. That's primarily related to two things. A lot of holdings that the managers have that are related to past IPOs where they have lockouts on before they can sell shares. The energy stocks, upstream and midstream, got hammered in the public markets during the quarter. That's reflected in that pricing. Also reflected in that pricing is what I think is a short-term drawback related to primarily Permian Basin and the fact that production is far exceeding the takeaway structure out there. There are a lot of projects, midstream projects that are in the works that are going to ease that, but for right now, there definitely is a bottleneck in the Permian, particularly the Delaware Basin, and that's led to differentials of between $10 and $15 a barrel on the price of oil. So that also has had some impact on energy pricing. For what it's worth, we already know that the next quarter, second quarter, we expect energy is going to be up significantly because the market turned around during that quarter. Looking at the longer-term returns, again, the portfolio is performing exceptionally well. One-year returns 12.76% versus a benchmark of 6.58. That's a spread of 618 basis points, 1.94x. The three-year return on the portfolio is 14.52% versus 7.43 on the benchmark. It's a 1.95x, 709 basis point spread. And the five-year return, which is one that we pay particular attention to, is 14.39% versus 8.43 on the benchmark, 626 basis point spread, and a 1.7x over the benchmark. At the end of the quarter, about 35% of our total existing capital commitments remained unfunded. 24% of real estate was unfunded, 53% of infrastructure, and 33% of energy. There were no new investments made during the quarter. However, in the second quarter, there were 3 new fund investments, which will be detailed in the next quarter's report and are detailed in the subsequent events section of this report. Those 3 totaled $500 million, and there was also 1 new midstream energy infrastructure co-investment with a capital commitment of $125 million. Looking at the allocations by asset type, and this is, again, is based on net asset value. It's on page 7 and page 8 of the report. If you take a look at that, so this reflects the portfolio on a purely invested basis. Portfolio was slightly over-allocated to real estate at the end of the quarter at 35% versus a target of 33%. Infrastructure was at 18% versus a target of 32%. Infrastructure is a sector where we have been under-allocated, but this was exacerbated during the period because we had several managers that had realizations in infrastructure, so we had capital returned to us, which reduced the NAV and reduced the exposure. However, as you know, infrastructure is an area that we've been focusing on for the past several quarters and for this year. So that is an allocation that will move up to closer to its target as the funds get called. Yes.
Does the investment in the midstream, the $125 million, go to infrastructure or energy?
That's an infrastructure. The energy was at 47% versus a target of 35%, and that, of course, reflects the emphasis on energy over the past few years and the fact that that capital typically gets called much faster than the infrastructure does. As I said, the infrastructure allocation declined due to several monetizations in that sector in the portfolio, that resulted in significant amounts of capital being returned. However, these allocations will continue to change over time and become more aligned with the policy allocation targets as more of the unfunded capital commitments to infrastructure and energy become funded. For example, if you look on page 8, this is a presentation of the allocations based on invested plus unfunded commitments, and you can see real estate there was at 30% versus a 33% target. Infrastructure is 27%, so significantly higher than the 18% on the invested basis. And energy was at 43%. And again, as we make new commitments and as those commitments are funded, those allocation targets will come more in line with the portfolio targets. Looking at geographic diversification on page 11 and 12, we're close to the targeted allocation for each region. Currently, our allocation to the U.S. is 94% of the portfolio compared to a 90% target, and the international allocation is around 6% compared to a target of 10%. On looking at portfolio investment manager exposure, that's on page 13 to 14 of the report. This also is on an NAV-based basis or an as-invested basis. And we're well diversified across a platform of 27 different investment managers. As you know, the policy statement limits the exposure to any one manager to no more than 20% of the total portfolio. And if you look at the, I know that's a busy chart, but I'll point out that the top 5 highest exposures at the end of the period was USA Real Estate at 11.49%. Again, the cap is 20%. Those was followed by NCAP Energy at 9.47, Macquarie Infrastructure Partners at 5.61, Lime Rock Resources at 4.70, and Morgan Stanley Real Estate at 4.66. Also, we have grouped the co-investment vehicles by manager and presented them separately. And as you can see, the highest grouped co-investment exposure at March 31st was First Reserve at 9.11%, followed by Intervest at 5.55, and ArcLight at 3.71. That's the end of the presentation. This is a non-voting item for information only, but I'm happy to answer any questions you might have.
Any questions at this time?
No questions from me.
Thank you, Mr. Martin. This being a non-voting item, and before we, no vote is required, before we adjourn, we just want to welcome David Hunn, Susan Carroll, and Theo Nguyen for joining us. We love having visitors. Welcome anytime. There being no further business before